Welcome back. If you're here for the daily briefing, you know the drill. We synthesize what really matters. We're locking in on the last 24 hours, January 12th to the 13th, 2026.
Yeah.
And the theme today, it's not just volatility, it's divergence.
It really is. We're seeing this profound bifurcation of trust.
Bifurcation of trust.
Yeah, it's basically a split in the digital asset space, and it defines everything, where the smart money is moving and, frankly, where the speculative money is just collapsing.
So you have two different worlds emerging.
Two completely different worlds. On one side, you've got the adult table. Think institutional entrenchment, qualified custodians, corporate treasuries.
And on the other side.
The casino.
Yeah.
Just regulatory chaos, legislative gridlock, and these, highly visible speculative failures.
So our mission today is to cut through that noise. We need to synthesize the tactical moves, the price action, the daily flows with these huge structural shifts.
Exactly. And that creates a very specific kind of environment, what we're calling defensive volatility.
Defensive volatility.
Prices are moving, sure, but the real story, the underlying narrative, is about protecting capital and securing long-term positions. The whole deep dive today really points to one crucial strategy.
And that's the barbell strategy.
The barbell strategy, overweighting the hard assets and the core infrastructure while ditching what we're calling that flimsy middle.
Right. The stuff that's not quite institutional grade, but also not, a hard asset like Bitcoin.
Precisely. That middle is where you get burned by projects with no clear utility or tokens that are just speculative derivatives.
Makes sense.
Yeah.
But before we even get to Bitcoin, we have to look outward, because what's happening in traditional finance is, well, it's pretty wild.
It's creating major headwinds for them, but it's actually strengthening the decentralized narrative. We're seeing this constitutional risk premium being priced into the market now.
And this isn't about inflation data anymore. This is about faith in the institutions themselves.
Right. You're talking about the Justice Department's investigation into Fed Chair Jerome Powell.
How does that move markets beyond just, guessing the next rate hike?
It creates deep institutional doubt. I mean, when the head of the world's most powerful central bank is under investigation, you're injecting political risk into the very foundation of monetary policy.
So it forces capital to look for assets that are genuinely uncorrelated.
It has to. And at the same time, you had this major populist move from President Trump calling for a 10% federal cap on credit card interest rates.
And the market did not like that.
Not at all. The reaction was immediate. Capital One, for instance, dropped a sharp 6.7%. But the second order effect is what's really profound here.
Which is, if you cap profitability for lenders,
they lend less. Banks will absolutely tighten their credit standards. They'll pull back. And that leaves a vacuum.
A vacuum that DeFi could potentially fill.
It strengthens the narrative dramatically. If the regulated banks won't or can't lend because of political pressure, where does that demand for credit go? It flows toward open lending protocols.
Okay, that is a fascinating structural shift. Let's pivot now to the main event, Bitcoin. The battle for $92,000 was fierce. Where are we now?
We're above it. Bitcoin successfully reclaimed and is now consolidating above that 92K control zone. And it wasn't just a technical bounce.
There's a flow reversal.
A major capital flow reversal. The data from Monday, January 12th was pivotal.
What did it show?
After some soft outflows, the U.S. spot Bitcoin ETFs. They recorded net inflows of about $187 million.
That's a huge signal.
It's a critical data point. It tells you institutions saw that dip below 90,000 not as a warning sign, but as a prime buying opportunity, a liquidity event they just scooped up.
So that $90,000 level is the line in the sand. What makes it so strong technically?
Well, it's a huge psychological number, for one. But it's also reinforced by the 50-day EMA, the exponential moving average, which is sitting right around 89,400.
And then there's the sailor put. I hear this term a lot. Can you break down what that actually means for our listeners?
The sailor put is basically the market's working theory that Michael Saylor's MicroStrategy is just a bottomless pit of demand.
A price-agnostic buyer.
A near-price-agnostic accumulator. Their corporate mandate is to buy Bitcoin. So anyone selling aggressively knows they're selling into a multi-billion-dollar buy wall. It creates this soft floor, this structural resilience for the price.
And what are the momentum indicators telling us? Are we running on fumes here?
No, the structure is cautiously bullish. The daily RSI, the relative strength index, it cooled off from overbought conditions, but the price didn't collapse.
Right.
And now it's rising from that neutral 50 zone. That's a great sign. It signals buyers are stepping back in with more strength. It's like the market just refueled for the next leg up.
We also just got the CPI data for December 2025. That always sets the mood.
It does. And the numbers were pretty subdued, which is good for risk assets. Headline CPI was up 0.3% month over month.
And core CPI.
Core, which is what the Fed really watches, was up just 0.2%, a little softer than expected.
So, a dovish read. How did the markets take it?
Exactly as you'd expect. Risk assets surged. S&P 500 futures jumped, the dollar weakened a bit, and that helped Bitcoin hold strong above 92K. It's a bit of a Goldilocks scenario, really.
Okay, let's move from the daily weather of CPI to the climate change. The institutional adoption, this Treasury Standard, this is the adult table, right?
This is the adult table, and we have to start with the titan, MicroStrategy. Their latest 8K filing was something else.
Give us the numbers.
They bought another 13,627 Bitcoin.
Just incredible.
And this brings their total holdings to 687,410 BTC. That's about 3.27% of the entire circulating supply.
3.27%. And they bought this last batch at an average price of $91,519.
Right near the recent highs. It shows extreme confidence, and it structurally raises that implied floor for the whole market.
And how did they fund it?
Through their ATM, their at-the-market equity offering. This is that radical financial engineering we talked about. They're issuing their own stock, which they see as fairly valued or maybe overvalued.
To buy a hard asset, Bitcoin, which they see as fundamentally undervalued.
Exactly. They see it as accretive to shareholders because they're improving the quality of the balance sheet. They're using cheap stock to buy premium Bitcoin.
So the core value of the company is shifting from its software business to its treasury.
It already has, and now we're seeing other players validate this exact strategy.
Like 21 Capital.
Right, ticker XXSA. They just bought 4,812 Bitcoin. That's over $458 million. It makes them the third largest corporate holder. And what's interesting is that Tether facilitated the purchase.
Showing how deep the professional liquidity in plumbing is now.
For sure. But then you have the really radical examples like Hyperscale Data.
Their announcement was mind-bending.
Hyperscale Data, ticker GPUS, announced its treasury hit 539.6 BTC. Here's the crazy part. Their Bitcoin holdings are now worth 102% of their entire market cap.
102%. So the market is saying their entire data center business is worth less than zero?
It's priced at a negative enterprise value. It's like buying a vault full of gold and getting the building it's in for free. It completely breaks traditional valuation models.
And none of this institutional money can really flow without the right plumbing. Which brings us to the BitGo IPO filing.
This is a huge piece of the puzzle. BitGo, the crypto custodian, filed to go public on the NYSE, ticker BTGO, targeting a nearly $2 billion valuation.
And why is a custodian IPO so important?
Because without regulated qualified custodians, the really big money pension funds, endowments, they can't legally enter the market. Their charters won't allow it. BitGo going public validates that entire model. It builds the compliant rails for the trillions waiting on the sidelines.
Okay. That's the adult table in action. Now let's cross the room to the casino, the legislative gridlock, and the speculative failures causing all the friction.
Well, the legislative process is still just agonizingly slow. The Senate Agriculture Committee just postponed the markup of the crypto market structure bill again.
What's the holdup?
The same old story, jurisdiction. The CFTC versus the SEC, they still can't agree on a basic definition for a token that might start as a security but becomes a commodity.
So we're stuck in regulation by enforcement.
We are, and adding to that, you have the banking lobby's fierce opposition to stablecoins, the yield ban conflict.
This is about deposit flight, right?
Yeah.
Banks are terrified of capital leaving their accounts for stablecoins that offer yield.
Terrified. So we got the Alsobrooks compromise. It would ban rewards on passive balances but allow them on transactional activity.
Which sounds reasonable, but I'm guessing the devil is in the details.
It guts the business model for many platforms. Their earned products rely on those large passive pools of capital. Defining and separating transactional activity is a compliance nightmare.
And while all this is happening in D.C., the unregulated fringes are providing perfect ammo for the regulators. Case in point, the Eric Adams NYC Token crash.
Yes. This was a perfect microcosm of governance risk. A token meant to fund city nonprofits. It spikes to a $600 million market cap.
And then immediately craters 80%.
And the on-chain data told the story right away. A wallet linked to the deployer allegedly pulled out nearly $1 million in USDC right after the peak.
It looks like a classic rug pull.
It looks exactly like that. And because a former major city mayor's name is attached, it becomes a national political football. It gives regulatory hawks the perfect tangible example to say, see, this is what we're talking about.
Which just reinforces the need for that barbell strategy. Stay away from that chaos. Okay, shifting gears a bit. What's the smart money looking at beyond Bitcoin?
Standard Chartered put out a really bold contrarian call. They're saying 2026 will be the year of Ethereum.
That is a bold claim. On what grounds? They're forecasting ETH to hit 7,500 by year-end 26.
Yeah, and maybe 40,000 by 2030. Their whole argument is based on utility. They see Ethereum as having a fundamental GDP because it hosts the vast majority of stablecoins, tokenized real-world assets, and DeFi.
They believe that network effect will drive its value relative to Bitcoin.
Significantly higher, yes. Meanwhile, in other Layer 1 news, Solana Mobile is pushing forward.
They set a date for their governance token, SKR.
January 21st. And they're doing a big airdrop to users of their Seeker smartphone. The goal is to try and decentralize the mobile app economy, which is a huge undertaking.
We also saw new, more specialized infrastructure popping up.
Right. Binance listed United Stables, ticker $1. It's a stablecoin specifically designed for machine-to-machine payments.
For the AI economy.
Exactly. It's a bet that as AI agents start transacting with each other, they'll need their own native currency layer, separate from our existing rails.
And finally, we got another harsh reminder that security is always the weakest link.
The EigenLayer investigation. It's a cautionary tale, a suspicious sale of $5.5 million worth of locked EigenLayer tokens.
And it wasn't a smart contract hack.
No, it was traced back to a simple email compromise of an early investor. It just proves that your on-chain security is only as strong as your off-chain human vulnerability. A simple hacked email can bypass everything.
So if we pull this all together, record institutional confidence on one side, spectacular failures, and political gridlock on the other, what's the final synthesis?
The market is screaming for the barbell strategy. Institutional success, like MicroStrategy buying at 91K or BitGo filing its IPO, is raising the floor for the entire ecosystem.
While speculative failure, like that NYC Token crash, is just inviting a regulatory crackdown.
Exactly. So the key takeaway for you, the listener, is that the market is transitioning. We are moving out of a phase of speculative mania and firmly into an accumulation phase.
An accumulation phase driven by corporate balance sheet restructuring.
That's the core of it. And that leads us to the final provocative thought we want to leave you with.
Go for it.
This corporate strategy we've detailed, issuing your own equity to buy a hard, decentralized asset like Bitcoin, is a radical new form of financial engineering. So the question is, how will traditional valuation models like price-to-earnings ratios cope when more and more public companies define their core value not by operating profits, but by the size of their decentralized treasury?
That's a fundamental rewiring of corporate value.
It is. And that shift isn't theoretical anymore. It's here. And it's what's driving the price action right now.